Multiple time frames. So understanding the goal of multiple time frames. It's all about alignment of pictures and the time frames that you want to use. Those pictures mean aligning the trend or counter-trend trades in alignment in those multiple time frames. Now, those trends have to be aligned with your investing or trading goals. Meaning, if you're trading XYZ for months or weeks, looking at a 5-minute time frame is not going to be to your advantage. Actually, what happens to most investors and traders that look at those smaller time frames, they give up a position where there's really no reason to do so. And focusing on day trading, looking at the monthly time frame is going to be of little use if you're trading and your goal is to profit within the next hour or so. What are the cons or disadvantages of looking at multiple time frames? Well, the pictures change, and that can become very confusing where you're looking at a bullish picture in a higher time frame and you're looking at a bearish picture in a lower time frame. But that also could present, if you know how to use it, a buying opportunity in alignment with the higher time frame. Many subjective tools, oscillators and trend lines, and they change their position or information as you change time frames, and that is one of the main reasons we don't use them. So once we pick our time frame for a bias, we plan how to trade it, and we stick to that until it changes, or as if the pattern would become climactic, and that telling us that the trend is likely over. Now, we can go to lower time frames, but their trend must be aligned with the primary. Smaller time frames will come out of alignment at times, and what we do is just wait for them to come back into alignment. Then we can even add to positions in those smaller time frames where that happens. Now, if you're a core and swing trader, as I said, there's really no sense in much lower time frames, but we can go down to the 60-minute time frame. And that's what we use for our long-term intraday time frame. But going down below that, the majority of times, isn't going to work out in your favor. Guidelines. As I said, we're looking for alignment of trends and inflection points. As we look at many time frames, to have them all aligned, it's rare, and it's just not needed. And to expect them all to be, well, not only can it lead to indecision, but you might be waiting a very long time. And you might think, well, when that happens, the odds are going to be overwhelmingly in my favor. And well, that's probably true. There's no guarantees. As I said, it's not necessary. Pick your primary time frame. That's where your bias is and your objective. Make sure the time frame above your primary is in alignment with that. So the time frame below your primary, you can use it to refine or add to an entry point. Now, we don't trade from lower time frames without a plan from the higher. It typically leads just to poor quality trades, stop outs that were completely unavoidable. So we want to put these multiple time frames in alignment because that's what puts the odds in our favor. So here's a simple matrix of using multiple time frames. It's really so simple. What we're doing here is just deciding what is our primary time frame. Right? P, primary time frame. That's where we're looking for our compelling patterns to initiate those trades. And what we're saying is, don't trade against the time frame above it. So if you're a core trader, don't trade from, and you're trading from the weekly, don't trade against the monthly. If you're a swing trader and you're trading from your daily, well, don't trade against the trend on the weekly time frame, and so on as you go down into your smaller time frames. Once they are aligned, so let's assume here that we're trading a swing trade, and here's our daily, and our weekly is aligned, well, it is okay to go down to the 60 to refine or add at that point, and so on. We'll use it exactly the same way. Pick your primary time frame, look for a higher to be in alignment, and then it's okay to go down and add. Now, on this slide is understanding the transition, as it says, from green to red. And many traders or investors, anyone looking at a technical chart, will get confused or sidetracked by a red candle against a bullish trend. And what we're looking at here is just that this transition, in this case from green to red, can look many different ways. All of these patterns, as we covered in candlesticks, it's about retracements. So as we're looking at whatever the time frame is that we're using at the lower time frame, this transition can look like this, can look like that, and so on. So here you just got a 2-bar reversal here, a topping tail, prices went up and came back down. We have a little breakout failure here, and just a normal move up and equally sized bars at the top and reversing lower. Transition from green to red, and we're looking at a few different time frames. This would be our primary, going down to a lower time frame, looking at some detail where we can see the momentum slowing down. So in a higher time frame where prices are coming down, let's say into a reference point where we want to be a buyer, where would that be? Obviously in an uptrend, in an area of minor support, or it could be in major support. As prices come down, we can buy above the high of a red bar. As prices come down, that would be an early entry, but it's taking out some resistance, the high of the red bar. Looking at a smaller time frame, lower, we could see that slowing momentum beginning to shift by taking that X-ray into a lower time frame. And here, as we go down to even a lower time frame, we can see how the picture can change, and we can see even more detail in a lower time frame. Now, we still do not want to go down here unless our higher primary time frame is in alignment for us to even go and look here. Because if it isn't, these type of patterns can and do develop, and you'll probably be tempted to enter when you see them because you know this is a bottoming pattern. You know this is a shift in momentum. But if it's not in the proper location, trend, and support, these type of setups or bottoming patterns often will fail, or you get a momentary move up, because that's what the pattern suggests, and you get a momentary move up, and then it fails and moves down. So for example, we might see a daily time frame. If you flip this around and change the colors, and it was going up and then beginning to reverse lower, but within the inside of that reversal down, intraday prices began to turn up again. Well, the primary time frame isn't supporting these patterns, so we don't take them. What will typically happen is the primary will follow through lower, and these, having this momentary move up, will then fail and go down, and you get stopped out. Primary trend to the downside. Higher time frame going down. Here's a move into minor resistance. What was support becomes resistance, and then as prices turn back down again, this is the transition, and as we see that X-ray into the lower time frame. Here's the transition as it turns up, and here we got a bottoming tail that was a little mini breakdown failure, and here was this transition back to the downside here. So looking inside of the bars, this is what we're seeing. Let's move on to part number 2, and here we're going to look at a lot of different examples. The focus of multiple time frames doesn't change, as already explained, but looking at a lot of examples here will reinforce those concepts, and we'll look at higher time frames and lower time frames and intraday time frames, and you'll begin to get a second sense of all of this and being able to put it together efficiently. Multiple time frames, part 2. In this section, we're going to look at multiple time frames from a longer term perspective for core and swing trading. Just reviewing a little bit of what we've talked about already. Multiple time frames, when we're looking at them, what we're doing is we're expanding data and compressing data, and we're going to see a different arrangement of candles. So we may or may not see the momentum slowing or the actual turn. I say there's no way around it. We don't want to look at too many time frames, so we may be entering after a larger bar. And by using multiple time frames, we'll understand what we're doing, and there'll be times where from a smaller time frame it may actually seem that we're chasing. However, by understanding the higher time frames and what's happening, as well as the addition of money management, we'll be doing just fine. And we could be then moving down to a lower time frame to adding at the appropriate time. So when our higher time frame, or our primary time frame is whippy, which will be confusing, we can then move to a higher time frame and compress that data, and it should bring clarity to what we're seeing. If not, we just don't trade. Now, if things are climactic, we then stand aside and wait for pullbacks. So here we have a monthly time frame. And what's happening here is we have a move up and then this long period of consolidation here. And you can see this is happening over the course of years. And the same concepts are going to apply. Exactly the same, just we're applying them to a higher time frame. And in this case, we have a bullish consolidation at supply or resistance. This prior high right here is where sellers came in, and this is a pretty sizable pullback going from 38 all the way back down to 24, coming up to this resistance here, retracing, which eventually became a higher low, and then push up, and then about a year or so of consolidation there, and a move up. And this is what it looked like on the daily time frame. Here you can see the blue stars. Here is the pullback, and of course on the daily time frame we have a break under the moving averages and down to this area of support where buyers begin to come in. Prices are chopping around, and at that point we really don't know whether it's going to drop lower. It certainly could have. Remember, here's the red bar, and that's this downward move right here, and that could have resulted in a move down here. However, looking at the daily time frame, we see the retracement and the pullback here and the bottoming tail. So we're seeing an improvement in the price action and buyers beginning to step up, and then a push up toward the resistance area here. Take note of the bottoming tail bar. We know that was a big wide range red bar. Prices come back up. As we're looking at these individual candles, it tells us that there's strong demand and buyers are stepping up. And also look at this move here, this momentum move which creates the void. And it consolidates, which creating support here and the bottoming tail bars. And then as prices begin to move up, you have time frames coming into alignment with each other. So here's the monthly chart. And now we're looking at it from a very long-term perspective, and big move down from year 2000. And it's a very long period of time of doing nothing and a move up. And it's the same choppy consolidation that we were looking at on the prior slide. And then here's this huge breakout. So this price action here was suggesting bullishly that prices would break out. And as they did, but we want to get in over here. If we're looking at this pattern, why would we do that as it started to break out? Well, there's this huge void and gigantic bottoming pattern, as I had said. So taking a look inside and getting a perspective here after the move started, and that is a great exercise in of itself, going back in time and seeing what things looked at. Because over here, this looks like really not much was going on or not much of a move. But in reality, based on what was happening here, the move up, which we just looked at, you can go back on the video and look at it and get another perspective and see what it looked like in the bottoming tail, and then the consolidation and the breakout. And here it moves up, a little pullback, and so on. And at this point, obviously, it's getting a bit extended. However, this is where we gain a bias from. This, at the moment, has a lot more room to go, potentially. And as time goes on, we look to buy pullbacks in the smaller time frame, and we apply the trend analysis that we've gone over, looking for prices to pivot and pull back and create new areas of support, and to see that this bullish bias from the monthly continues in multiple time frames. All right, so let's look at a few more examples. We've got the foundational concepts down and what to look for. And how do we gain a bias here as to what's happening? So we can now apply biases from different time frames and keep things in perspective from longer time frames. So what we're looking at here is a situation where a monthly is in a downtrend. Do we want to buy this from the monthly time frame? Absolutely not. Can it go higher and have a substantial move higher? Absolutely. So as it comes up into this resistance area, clearly we then think, well, enough's enough from the smaller time frames. Whereas the weekly has pushed up above resistance here, and it has room to go higher. And now look at the daily. It's up above the moving averages. It's consolidating here. In other words, do I want to buy a breakout, looking for prices to go higher? Sure. It's improving here. Price is gapped up. It's creating support. It's above the moving averages. It's got room to go higher. But I know I'm not going to stay my welcome too long. But from this perspective, can I swing trade it? And yes, and the odds are in my favor. But I know that where the potential is and where it's likely going to stall. Okay? So swing long is okay, only. All right, and look at another example. Monthly breakdown would have been great to be looking at this here. How do you catch these? Well, you got to scan the monthly time frames and get a bias. And here we had a big head and shoulders type of top, and it broke down. And this is where we'd be looking for short setups. Now, the weekly is still in a downtrend. There's a void below. The daily's in a downtrend. All we want to find here is shorting opportunities. So a base, and this isn't a very mature base at this point, but if it consolidated for a while, we could then sell a breakdown. We might get a retracement into the resistance, the minor resistance area, to sell it short as well. Okay. So we don't neither here. So as I said, stand aside. So here's prices breaking to the downside here. Got room to go down. It's extended on the daily. The weekly is also extended, so we just want to stand aside from this. Do we want to core swing this? Well, the monthly here, it's a little extended. I've got a nice turn. We have a correction going on the weekly and this consolidation, but it's really pretty sloppy. And the daily is also sloppy. It's improving. I'm not sure where this is going to go at the moment. So it says it could be both, but things have to tighten up. It's just too sloppy here. So let's wait for it to consolidate and gain more information. All right, swing trading and opposing trends. Well, look at the weekly, and it's in an uptrend. It's pulling back to minor support. Prices are beginning to reverse. That looks pretty enticing for a turn and a move back higher. Now, as I go down to the daily time frame, it's in a downtrend, but it's beginning to transition. You can see the move down and the retest, wide range bar up. Don't have the volume here. Red bar. I'd like to see this consolidate a bit more, but it's very interesting. So I'd keep this on our list, looking for the daily to begin to tighten up, to be a buyer, which would be in alignment with the weekly uptrend. So ideally, this would be a base a bit more, but the weekly stop makes the entry okay. Meaning, if I put my stop down here with the proper money management, it would be okay to be a buyer, and giving it room, waiting for this to develop, and then looking to add. Weekly time frame, retesting in a downtrend when it's beginning to transition. Note the breakdown failure here, the retracement up into resistance, and then coming down to retest. And on the daily, beginning to turn, you can see the turn right here, the green stars, and the move back up. So here would be looking to buy this transition, right, from red to green, looking for prices to move higher. Swing trading with the trend. Here on the weekly uptrend, prices are retraced back down to the bottom of this wide range bar. It's certainly not ideal, and it is definitely a concern. The angle of retracement was sharp. However, it's in an uptrend at minor support. Looking at that, the trend has to be our primary focus here in providing our bias. As I said, this pullback to this level is a bit of a concern because it's retraced the wide range bar. Think about what would be the ideal when we see a wide range bar. And I've covered that a few times. And that would be a sideways consolidation at the top of the wide range bar. Now, going down to the daily, it's into a gap fill. We have a pivot right here where it pivots and creates some support. Then we get a retest, making a W type of a bottom. 50 MA is also in this area. The 20 MA, while declining, is just a line that we put here. And overall, this pattern is one telling us that buyers are stepping up and it should be able to move higher. So we would be a buyer of this, knowing that it can move up substantially. It's going to stall over here. The weekly's in an uptrend. It's not likely to take out this high without a period of chopping around when it gets here. Now, we make some assumptions when we look at these patterns. Those being, as I explained, this type of retracement, the angle, the retracement to the wide range bar. And when it gets up here, it's likely that it's going to stall. It doesn't mean it can't get through it. It just means that when it gets there, we're probably going to sit through some choppy consolidation. We might want to tighten stops, reduce part of that position, and then we just manage it accordingly. All right, let's go to multiple time frames, part number 3. Multiple time frames, part number 3. Here we're going to be looking at some intraday charts to review what's happening on the higher time frame. We have a daily chart that is extended. It's climactic. As prices are extended into this area of support here and begins to stabilize, this gives us a bias that prices are likely to retrace. So we can move down to an intraday time frame, and here we're looking at a 60-minute chart. As we can see, this little consolidation here, prices are in a downtrend. We're not considering going long on this until this 60-minute time frame comes into an alignment with the bias of this daily that suggests it should be able to retrace a bit. So as prices break to the downside and immediately reverse back up again, well, that gives us a clue. Now, this bullish price action here, I pointed out to you numerous times, this type of price action, sideways action, after, in this case, it's a little void, it's not that big of a move, well, it's bullish price action in an area of resistance. It's absorbing that supply. And we look at individual candles, where look at the size of this big red bar. It doesn't follow through. An immediate reversal back up again. So at this point, say, well, this is a good opportunity to get long, looking for this retracement that should have started here, and wide range bar up, volume, consolidation, minor support, all the things that we've talked about, suggesting that this should be able to move higher. Here we're looking at the same 60-minute chart. Here prices are now pulling back into this minor support. Certainly might be able to turn and continue to move higher based on the daily. Now here we have the starred points, the same entry point looking down here at the 5-minute. Prices have now pulled back to that minor support, and on the 5-minute chart, we see that the momentum is beginning to slow down here and maybe making a transition back up. It's still too early, so let's wait. I want to look at two different bottoming tails here. On our daily time frame, we have a bottoming tail bar right here, and we're looking inside of that. What we're doing with multiple time frames is looking to gain our bias from the higher time frame. And in this case, the daily was a nice run up and a consolidation. I have a bottoming tail bar, a green reversal back up. I look at my 60-minute chart, and here's the run up. Consolidation where it looks like it's going to start to roll over. We're not interested in shorting this because our bias is that the bullishness of this move should continue. And notice on the daily, it's coming out of a base. This initial move here, we could say, well, it's a little short-term extended, but it did not occur from prior move that was moving up substantially. Rather, it came out of a consolidation where it went sideways for quite a long period of time. So this move here, once we get the confirmation, we can consider going long. And we're looking for alignment of the multiple time frames. So this move to the downside, immediate reversal, bullish price action at resistance, go ahead and you can be a buyer on this breakout. Now this bottoming tail bar, it's still in an uptrend. It's pulling back into support, but the 60-minute tells us it's not ready yet. We do have the beginnings of the turn where prices broke down. Relatively deep retracement. It's up into minor resistance. So what we need to see now is a little bit more bullish price action to be a buyer from the 60-minute. So could you be a buyer from the daily? Well, at a minimum, it has to trade above the bottoming tail bar's high, which would put it above here, which would put everything in alignment. So we're waiting. Here we have a pretty deep pullback into major support. So we're going to be waiting here to see what will happen. However, what we're really interested here is the fact that this buy setup at minor support is actually failing. Look at the topping tail right here, the red stars. And as this came right back in again, and this little bottoming tail bar, this certainly could have been a buy setup looking to enter this here on a continuation. And you say, well, what about the topping tail? Well, the topping tail has to be discounted to a certain point because of the daily here being pulling back. It's in an uptrend. It's at minor support. We don't know that the red bar is going to happen, of course. So intraday, well, we'd be looking at this topping tail because it was here and pulled back. Everything, the assumption is that everything is going to come together. Assumption because of the daily, and buying at this point would have been okay. It never triggered, and then it traded down under this point right here. So what now? Well, now we wait. The same way we looked at the other where prices began to turn. Now that it's at major support, the same might happen. Or are we looking at the intraday time frame? We wait for this time frame to come into alignment with our bias that major support is likely to hold and looking for prices to reverse back up again. If they break down into the void, well, then we start looking for sell setups. But we don't look for sell setups in an area of major support. Daily time frame, double top up here, topping tail, shock. It broke out to a new high and came right back in again, and then the gap down. So on the retracement up into this minor resistance area, we begin to anticipate a turn to the downside because of the daily time frame bias. Looking at the intraday, this consolidation and the breakout that immediately refails and turns right back down again. Here's the red star, both here. And now it's broken to the downside and begins to create a resistance area. We can sell short or sell a breakdown here down into the void. Multiple time frame alignment. Based on what I've already showed you here on the daily, the breakdown into minor resistance. The failure here intraday provides us a bias that prices are going to go lower down into this void. Here's a very powerful combination, multiple time frames, daily in a downtrend. And this push down under the prior low. Here is one of our retracement concepts. A greater than 100% retracement suggests this momentary stall within the trend. And that's exactly what happened. They gapped up, and there were sellers right there at this little resistance area, these overlapping opens and closes, and then consolidation as that supply kept coming. So as prices began to break down, looking inside here, see what happened on the intraday time frame. In this case, we're looking at a 5-minute. Note the breakout failure here. That topping tail tells us that traders got caught. And then we get a wide range bar igniting to the downside. And this gives us our sell setup on the retracement back up. We always have to give the big picture the advantage of it's going to follow through, and that's our bias. So in this case, when we're looking at this huge volume and price reversal back here, say, well, the trend trumps that volume spike reversal. Moves to the upside on huge volume are a powerful message. However, a more powerful message is the fact that this is in a downtrend. It failed. It's breaking down. The intraday time frame's in alignment with that. It's up into this area of minor resistance. We look to sell short. Intraday play using higher time frame as a bias. Our daily time frame is pushing up into this area of resistance. The retracement here is a deep one. So I know on a higher time frame this is actually reversing back higher because of the depth of retracement. However, it's into an area where it's revisiting this topping tail, which was a huge shock. This consolidation after this move up was bullish. And then as prices broke to the upside, it immediately failed and prices moved lower. So here was a good sell setup. But as we're here at this moment in time and this move up, 60-minute chart in an uptrend, it begins to break to the downside. There's a void below because of the momentum move. And now as we take that X-ray down into the 5-minute, and you can see the trend is down, this consolidation right here after the break creates a resistance area. So here we have a pivot, begins to pivot, breaks lower, retesting. This gives us an entry point. Why here? A bullish bar failing. Notice the bottoming tail bar, the green bottoming tail bar. Why would we sell short under there? Because of our big picture bias. 60-minute intraday is consolidating. Here's our daily up into this area, and it's come down to this area of support, this cluster of opens and closes. So what is it going to do? Well, the daily chart says it should go lower, but it's been trending up. This type of a pattern can repair the damage. However, we don't know that that's the case, so we would wait and see if this consolidation here can actually resolve itself to the upside. In this example, we've got a daily pattern here that's potentially bottoming. We've got a bottoming tail bar here. You've got a gap to the downside and a strong reversal on that retest. Now, you say, well, why is potentially bottoming with this bearish gap down and move lower? It happens a lot during a bottoming process where there are attempts to move up that fail. We really don't know whether this is going to bottom yet, but we have clues that that has the potential, as I explained what happened here. And of course, we'd have to see that this red bar negated, so we have no interest whatsoever of trading or buying this from the daily time frame. Now, the wide range bar, any wide range bar, is going to be a momentum move in a smaller time frame. As you can see here, the green bar, this momentum move higher, and the red bar, a momentum move lower. How could we utilize this with a bias? Possibly. The daily time frame potentially bottoming here, we could have a bias that this red bar could be ignored, just as this gap down was ignored. Do we have a setup here on the 60-minute intraday time frame? Absolutely not. It's a little extended, but it just got going here. So we need more information. We could wait for the 60 to develop and see actually what happened here. However, this is on a new day, as it started to move up, we could move down to a 5-minute time frame with a bias of, as I explained, a climactic move to the downside on the 60. And as the 5-minute trended higher, we could trade that long with the appropriate pattern. All right, so here we have a weekly and a daily, back to the higher time frames. And on the weekly time frame, what we're looking at here is this transition attempt to turn higher as it's retesting this bottoming tail bar here. Note the red bar, no follow through, this bottoming action. As we look inside of that, we can see the price action here, the volume. Here's the retest. Right? There's the bottoming tail bar right there. Here's the retest of that, the move higher, the retest again, the retracement, move up above resistance, breaking the downtrend on the daily time frame, wide range bar on volume. So we have an igniting bar with confirming volume. As it pushes up to test this resistance right here, we then get the pullback and a bottoming tail bar. This is an entry point on this retest of the bottoming tail bar. Now, the assumption is that it would stall here, but this is the best entry point. And why is that? Because we have more information. We don't know that this would consolidate like that and give us this bullish price action. So if we entered here, we would be in if it just took off. We don't know if this is going to happen. What should we do? It becomes a choice. Meaning, do I wait for this possibly to happen? It might not. I might miss the move. Can I buy it here? Yes, with the proper money management, which we're going to get to. So we'd have to give it a bigger stop because there is the potential for wiggles to occur here with this pattern. We know 2020 hindsight that it didn't. That's part of trading and the unknown and having a trading plan and how we're going to handle. The big picture bias said it was going to go higher, so I would be okay entering here with a larger stop. Now here we have a downtrend. This is a daily time frame. Prices are moving down. They're retesting the 200 period moving average. It's just a line in the sand that we use on the daily time frame. Clearly prices could have continued to go through it because the daily, as I said, is in a downtrend and prices broke down. Now, as prices retested this low, you had a pretty strong move back up, and then it continued to do so and actually takes out this resistance area right there. You've got two retracements here, greater than 100% retracement. As I said, those greater than 100% retracements are points in time where you're likely to get a momentary turn. Question is, are they actionable? Well, looking from this time frame, the one here at the bottom, no, not from this time frame. However, as an intraday trader, there might be, but probably not as I'm looking at this. However, this one is because it's broken the back of the downtrend. So based on that, we can have a long bias, but we need more information. So here's what happened and why. The daily, as we talked about, was in a downtrend and retesting the 200 period moving average. Looking at the weekly time frame, we can see that it had been in an uptrend and had been moving down. So downtrends on the daily time frame, we can still have what would be an uptrend on the weekly because it had not violated major support. Remember our conversation about prices being in a downtrend based on lower highs and lower lows, however, still above major support, which gives us still a long bias with the appropriate pattern. And that happened here once prices began to pivot and then the retest and the move back up. Here's the same point in time as that began to happen. And note the red bar to the downside. Note the 3-bar reversal here, which is a bottoming tail in a higher time frame. It either has to be a bottoming tail or a 180 type reversal, meaning red bar into a larger green bar. The narrow range bar, the little bottoming tail bar right here, is the transition from that red to green, or the bottom of the bottoming tail bar. This is the monthly time frame where prices had moved up off of a bottom. Note the break to the downside here, the move up, the bullish price action, the strong move higher, and here's just a pullback within that upward move, bottoming tail bar looking for a move higher that ignites this move starting higher, which once we have that bias, and it's into, let's assume that this is a void here, we then look for buy setups from the lower time frame with that bias. Pullbacks, another pullback, retest, so on and so forth. Breakout, which didn't go all that far. We never know how far they're going to go. But here's the pullback into support, and we just continue to repeat the process. Now, one thing that we haven't covered is being aware of, and this doesn't necessarily mean it will ever stop a move, but being aware of these whole numbers will also come into play on a very short-term basis as prices move up to them. Here's a review. Your primary management time frame. Is it trending up, down, or sideways? Time frames above your primary, they must be aligned. Its transitions from red candles to green or vice versa are relevant when your primary time frame is at an inflection point. That's where you look for that actually to happen. Pull back into minor support in an uptrend. Wide range bar in a higher time frame is going to be a momentum move in a lower. And higher time frame failures, they start in a lower time frame. Meaning of that, you have a climactic move to the upside before that begins to turn or fail. You'll see the transition in a lower time frame. You are definitely becoming a master trader. Review this section again to understand multiple time frames. It's one of the most powerful concepts, especially when you start combining it with everything that we've talked about.